the story.
Okay, yeah, you handle that. All right, well, welcome everyone to our webinar, How the Election Results May Impact Your Portfolio. I'm John Sanchez, CEO of Sanchez Wealth Management, and that handsome face, of course, Jason Gaunt, COO of Sanchez Wealth Management. Yeah, I'm talking to you, buddy. I'm talking to you. Oh, goodness. All right. Well, we thank all of you for joining us this evening. We do hope to make this an extremely informative event for you. So many things that we're going to be talking about. We know that many of you are as excited as we are as far as what the new administration is going to offer. It's kind of like a breath of fresh air that we have looking forward to us for the next 4 years.
Yeah, I mean, I'm just thrilled that we're not still sitting around counting hanging chads and so on and so forth. It's done. We have a decisive outcome, and now we can move on to some of the planning, the part that we
Yes, exactly. And as we mentioned on the radio show this afternoon, brand new, fresh news, of course, that the Republicans, we did take the House. So we have this trifecta sweep, which, to be honest with you, we're going to kind of talk about that and its impact on the fly, because we did not get a chance in our slides, because obviously we did not know up until a few hours ago that the House was going to go to the Republicans. So that even creates more of a kind of an incredible scenario, does it not?
It does. And we touched on it a bit earlier, right? It seemed a bit confounding, but typically the markets, historically, presidential elections, they tend to favor when you've got a mixed president in Congress, right? I often say that the market doesn't like what it doesn't know.
Right.
If you have an all red or an all blue, the probability of something changing tends to increase, right? Whereas what we've been used to more often than not is one person comes up with an idea and the other one just says no, and it takes forever for anything to ultimately change. And so you can tend to see a bit more volatility in years where you've got a all Republican or all Democratic government. Not to say that that's a negative, but volatility oftentimes goes hand in hand with change.
Absolutely. You bet it does. Well, let's kind of briefly go over the agenda and a little housekeeping note, of course. We're going to hold the Q&A till we're done. We should probably take us about 45 minutes or so to get through this, and then leave around that last 10 to 15 minutes for a Q&A session. You want to explain, Jason, to everyone how we get them involved in the webinar?
Yeah, absolutely. When everything is done, you'll do see we have chat turned off, unfortunately, given internal regulations. But there is a hand there that shows where you can hit the speak button and you queue up, and John will use the big magic gotcha, and we'll get the ability for folks to come on and chat with us directly, either through your camera or just through voice.
Absolutely. All right, so let's go over once again what our agenda is this afternoon or this evening. So we're going to take a look at historically how the stock markets respond in a time period like we're in right now after an election, right? There's some incredible data, historical. We've covered a little bit of it on the show over the last few weeks, but Jason's going to share with us some of the incredible data of what this market historically has done after a presidential election. We're going to spend a lot of time talking about sectors, right? Sectors are something, of course, that you want to pay very close attention to. Doesn't mean you have to own sectors in your portfolio, but we watch sectors and we invest in them in our portfolios because they are a great indicator of the health of the overall market, right? If we see strength in, hypothetically, in a semiconductor sector or biotech or something, that garners our attention, and that means maybe we want to be involved in those sectors. So we're going to go over historically how sectors work under a Republican administration, what ones work well, which ones work a little bit on the poorer side. We're going to talk a bit about taxes and interest and inflation this afternoon on the show. And if you missed it, please pick up our podcast. We spent the entire show talking about inflation and the impact on our lives, on our pocketbook, on the portfolio, and of course, on the stock market side of things. And so we're going to definitely be speaking about that one. We'll talk about some long-term and short-term strategies that we think garner some attention and some thinking going forward. And then, of course, some actionable steps to grow your portfolio and really in some of these uncertain times. Also today on the show, we spend a considerable amount of time talking about, it's our job as advisors and as portfolio managers is not to be emotional. We've got to be right down the middle. No matter what our political affiliation is, we have to be unbiased opinions to make the proper decisions for our clients. And so it's not all, a bed of roses just because we all wanted Trump to win and we all wanted a trifecta. It doesn't mean that there's not going to be some bumps in the road. And so what we're going to try to do tonight is talk about how do we handle some of these uncertain times that, again, may loom in the future. We don't know. There always is. I can guarantee you the stock market is not going to go up every single day for the next 4 years once January rolls around. So we got to be prepared for that. So we got a lot of things to cover with you. Let's get right down to it and begin the presentation and talk about what we need to be thinking about going forward. So once again, if we really start to think about where do we sit in this type of an environment, right? How historically has the stock market responded under different scenarios? So Jason, let's talk about from a historical standpoint what this market has done, because it doesn't mean history is always going to repeat itself, but many times it's a great gauge to kind of get things kicked off as we enter into a new administration.
Yeah, no, and it's not atypical to see strength running up to an election and then almost some, I would say, let down immediately after, right? Again, we use that analogy of a birthday that I've talked about in the past, where no matter what you're excited for, the reality tends to trump, pun intended, the result. And, it's not uncommon to see, on average, the market running anywhere from 2 to 3% over the months leading into the election, just ahead of an outcome. And then afterwards, on average, the median return 6 months after the election, ironically, is down about 3%. And it doesn't really end up being average a function of who wins. Like I mentioned, slightly better results when you have a Democratic president and a Republican Congress, but all of the forward returns a year and 3 years out are positive to the tune of 7 to 12%, given various outcomes. So again, the normal glide path is some strength into the election. Historically, within the next 1 to 3 months, you see weakness, but then followed into new president making new promises, and folks tend to get excited about the outcome. So I would say prepare for a little bit of bump over the next several months, but again, given historical data, expecting a green year ahead.
And the logic behind it, of course, is there is an era of excitement. I liken it to the way we felt as a child when it was Christmas time, right? You're so much anticipation leading up to Christmas, which is what we just had leading up to the election. Then Christmas Day comes and you open all the gifts and you do everything fun, and then it's kind of a letdown. And that's exactly what the market goes through. It's somewhat of a letdown. Doesn't mean it's always negative, but at the same time, there can also be an air of optimism, right? Oh my gosh. And as we'll talk about here in a moment, there's a lot of things that are going to be changing. And so that's why we're extremely excited about what these next 4 years are going to bring us. I mean, that's the bottom line. So now let's begin to analyze some of the various sectors and the impact of a Republican-controlled Congress and White House, what the market expects from that standpoint. So we're going to start off in an area that we have seen a tremendous run-up leading up to the election, and definitely the 1,500-plus point day gain last Wednesday, a week ago after the election. The financials were one of the leading sectors. They just rallied like you can't imagine, and they've continued. Other than yesterday, they've continued to rally. So the banks. Why have the banks rallied? Why are they anticipated to rally going forward? So basically, the rationale that's behind the bank side of things is they are big beneficiaries of deregulation, right? There's been a tremendous amount of criticism in the Biden administration regarding the Federal Trade Commission, mergers, acquisitions, all the things that keep the economy humming along. It's been very difficult for companies to get what they want as far as merging together, so on and so forth. Well, there's anticipation, of course, in the Trump administration that you're going to see a lot less regulation. So therefore, we will use the term deregulation. That's going to benefit banks. It's going to benefit large Wall Street firms because, as we all know, Wall Street firms make a lot of money in mergers, acquisitions, in different types of corporate activity like that. So that's why you see in our second area, the investment banks increased. We're already hearing it. You've seen the interviews of various CEOs on your favorite financial channels. Many of them are they're like little kids. They're giddy right now. They're saying the M&A activity, they're already getting phone calls and companies wanting to get ready for next year and the year after because they know deregulation is going to be a huge benefit for them. So we're going to see increased M&A activity. Crypto, well, from a regulatory standpoint, as we always say on the radio show, we can't really talk about it a lot. You've seen what's happened with various cryptos leading up to the election, and even since then, that's pretty much all we can talk about. We know that both candidates were very pro-crypto, so we'll leave it at that. Again, unfortunately, we can't get into details as to the real reasons behind that, but by many on Wall Street, they're anticipating that that is going to be a very strong area. Jason, let's go to one of your favorite areas, which is the energy sector. And why is this going to be good under the Trump administration?
Yeah, and I just quick follow on with the bank slide there, right? All banks are not the same, right? So when you're going and looking at what type of allocations you're looking for, John correctly mentioned deregulation. He also touched on M&A. Well, you can do your research on a host of different banks that show up on the leaderboard as far as M&A is concerned. And you can see names like a Goldman Sachs, a Morgan Stanley. They've outperformed a ton, even just month to date since the election happened. That's a big reason. And we've mentioned this before. Everything that we cover tonight, we're going to give you our view on it. But some of these things have already had some decent moves. Make sure that you're layering into trades, layering into bets versus going all in. Just given the fact that we've had some moves just immediately after the election, but it's just kind of want to throw that out there. So you're thinking. So looking at the energy sector, a bit of a misnomer, certainly with the Trump administration. Like they're not anti-green energy. I would argue they're actually just pro-energy, trying to be energy independent versus dependent. Is very much a goal for many in that group, as well as probably many of you listening to the webinar tonight. But certain parts of energy are going to flourish under a Trump administration. Some, like clean energy, specifically solar, those types of sectors have thrived under stimulus. They've thrived under tax breaks. Will we see those again? Elon Musk is clearly a part with his Doge acronym new job. That may potentially be a stimulant to some extent in solar or at least alternatives, but looking more so as the classic oil names, right? People think, okay, well, we're going to be drilling more. That can benefit oil services companies. But remember, same thing, and everything that we talk about tonight, they're not all the same. Right? If oil prices, if there's more production, it may not be a benefit for a ExxonMobil, a Chevron, names like that. Whereas it could be a positive for oil services names, the folks that do help with the pipes, that do help with the drills, things along those lines. More again, you can, much like John said with crypto, we can't get too deep in it. There's a lot of exchange traded funds, oil services, you can go and do your research on, but those may be some areas that could benefit from added focus in the energy space and the continued desire to be independent. Coal names come up. We've got a couple domestic producers, much more overseas international producers for coal, but you could see that certainly flourish again. And then finally, utilities. There's been a big move in the utilities space for all the reasons we've talked about, AI, which we'll get into a bit later. The need for energy is only going to increase given all of the use cases for all of the technology that it seems we keep hearing about. Energy is number one, number two, and number four as far as what's going to be required to power us into the future. So this is a good spot that's been under some pressure. Oil has not done very well. Oil energy names have not done very well, but ironically, since the election, it's number 3 on my leaderboard here for strength so far. Consumer discretionary, number 1. Thank you, Tesla. Number 2 is financials, which we've started on, and then energy. Those are the 3 sectors that have done the best since the election.
I think one of the areas of the utilities that excite you and I the most on the utility side, of course, is that you mentioned the AI. Many of you have seen, you've read, maybe you've invested in some of the nuclear facilities that are being reopened, or the companies that are producing new nuclear facilities, smaller, faster construction times. It's an exciting new area. I never thought in my lifetime, Jason, I would say, hey, we're happy to be seeing 3 Mile Island reopened up, but it is because they signed a contract with Microsoft. Microsoft needs a whole bunch of energy and utility power coming from them. We've seen it with Amazon. They've inked deals with numerous companies. It's a, excuse me, it's going to be it's somewhat of an infancy stage at this point, but just common sense says as AI grows and these massive server farms, et cetera, come around, then they need power. So what are they going to do? Nuclear has now been discovered as one of the cleanest, cheapest ways for these companies to do that. So it's not, when I got started in this business 35 years ago, this was a, what we call a widow's sector, Jason, right? Just like you starting. It's not that way anymore. It's not your grandma's area. It's very exciting with all the things going on at this point.
And there's been some recent IPOs in the nuclear tip-up space, like we've talked about, some smaller companies that could still have a fair amount of meat on the bone. So you can go out and do your research on those names as well. Because nuclear will be something that will be part of all of these energy needs.
All right. One of the things the Biden administration did do that we liked, and it's going to continue in the Trump administration, and Trump actually started it, he just couldn't get the ball over the goal line, was the infrastructure spending. This country is spending a significant sum of money, and hopefully they'll spend even more on infrastructure. We know we need new roads, bridges, and so on and so forth. Well, that takes infrastructure spending. So the areas that we like in the industrial sector, areas like the steel stocks, tariffs, this is going to be interesting, right? We know that Trump is going to dive right into the tariff situation. Our anticipation is it's going to start with China, and who knows where it goes from there. But if it's a repeat of the 2016 time period when Trump was in office, he very much favored U.S. steel companies, not the company U.S. Steel, but U.S. steel companies, right? They all of a sudden gained a very competitive edge because the other countries producing steel, such as China and others, they got slapped with massive tariffs. So it was significantly cheaper for companies, municipalities, et cetera, that needed steel to buy, I'll call it locally, meaning the U.S. So this could be a really interesting area going forward for domestic producers. The infrastructure spending, as I mentioned, $1 trillion proposed investment in infrastructure, that's going to drive demand. So keep an eye out for the different, national construction companies that are out there. And then, you can go right on down the line. That's the fun thing about construction. You can start with the material suppliers. You can go down to the construction companies, and even something as simple as the rental companies, right? These companies need to go rent equipment. So you just let your imagination wander and just kind of go down the food chain, as we say. And there's a lot of different areas of the market that can really benefit from this $1 trillion plus. And then you get into rail stocks. Again, coal production increases could boost demand. And bottom line, if the country is humming along, the economy is humming along, there's no more effective way to transport goods than, of course, on the rail. So watch the rail line sectors also as some potential nice upsides. Oh boy, defense. This is a touchy area.
And this has actually already had a very strong move prior to the election. The Northrop Grumman, Lockheed, all these names, for all of the reasons pre-Trump was, Ukraine and the military spending that's been going on there. Obviously, Israel, Hamas, Gaza, Iran. These are going to be hotbeds for some time, right? Recall, Trump, I would say, had a slightly more incendiary relationship with some of the countries, China, Israel, not Israel, but China, Iran, right? So we're going to hear more about defense spending, spending in general, certainly to prop up domestic protection. We've probably done a decent job of cleaning out some of our old materials and missiles, et cetera, during Ukraine. So I would expect that this space continues to see demand for years to come. Looking here at the chart in front of me, national defense is the number 6 spend as far as government outflows is concerned. And I think that's going to very much be the case. Probably a refocused military, a desire to prop up and support our troops has been certainly something that was run on, discussed, and I would expect that doesn't change at all once Trump gets into office.
And while we're on the subject of defense, it's a good time to give you a little reminder. We get a lot of phone calls, such as the October, if you can believe it's already been over a year, October of 23, when Israel launched that first attack when Iran launched that first attack on Israel. People want to jump into the defense stocks, and you'll see those to be very cyclical. They'll run up when events heat up on a global basis, and then they kind of calm down. If you're going to get into this area, make it a part of your long-term allocation. Don't try to jump in and out. It's very difficult. Many times you don't see the defense companies run up for any sustained period of time, again, unless, God forbid, a protracted war exists. But just from Jason's point of the defense spending, we know Trump wants to spend a lot of money, the Trump administration. So overall, that should be very, very positive for that group. All right, move on to our next area, the healthcare sector. Well, we're all getting older. We all need healthcare. And this is one area, of course, that, once a month on Fridays, it's always a Friday, when Jason and I cover the non-farm payroll numbers, and we go through where were the jobs created in the economy. Almost every single month, usually it's, at least in the top 5, if not number 1, it's healthcare and all the different areas related to that. The pharma biotech sector, less scrutiny on drug pricing could be a positive for that sector. You've got the hospitals. Now, there's some concerns there, of course, over ACA. And, is Trump going to go back after the Obamacare, as he tried to do numerous times in his last stint in Washington? We don't know. This is an area you got to be very careful about. I remember, and I can't even remember, I think it was when Hillary Clinton was running years ago, we saw a significant drop in healthcare stocks, meaning the pharmaceuticals, because she wanted to go after them. So you've got to be very careful in this area based upon who the Department of Health leader is going to be and what their programs are going to lay out, because it can be a great area depending upon the administration's look at it, or it can be a very tough area. Especially watch this very carefully if we start to go, if Trump starts to go after the ACA and dismantle Obamacare and so on and so forth. So kind of a not one of our favorite areas, but again, something that may be a small allocation, 2 to 5% of a portfolio, probably no more than that. Don't you agree?
And the biotech sector too, right? Bank shots on AI, right? Areas that can benefit from big data, machine learning, being able to crunch through myriads of tests and test for DNA strands. Think of, not to keep it specific to the election, but this is an area that I would say has been stagnant, biotech, for a number of years, stuck in the mud, and started to perk up a little bit when interest rates were coming in for a brief period of time, and they've gone back up, and biotech suffered. Remember, because companies in the biotech sector tend to have to borrow money to fund their business. They're not very cash flow positive until they get their big drug or someone else comes and acquires them. Another reason why biotech potentially could be a darling over the next couple of years is that M&A that we talked about, right? Johnson & Johnson and Pfizer and all of these big companies, they've got patent cliffs. They're coming off of their sort of COVID moat, and they need new drugs. They need new items to feed their pipeline over the next 3 to 5 years. So if you want a bank shot on M&A, biotech could be a great place to be picking at.
And of course, biotechs, they live and die by a lot of infusion of capital. If capital is cheaper, i.e. lower interest rates, that's also another very important reason that they could be a great area. But again, very cyclical. Oh, all right. Let's get into an area of consumer finance, right? This is something we all are participating in, the credit and lending. Again, potential regulatory easing for credit card companies, reduction in scrutiny of fees. This is an interesting area. Now, I don't know if many of you follow the Consumer Financial Protection Bureau, CPF, Consumer Financial Protection, whatever the acronym is. This has been an area that Trump did not like. This is a very, very powerful government entity that really has an unlimited budget. I literally say they're the most, you think the IRS is powerful, so is the CFPB, because they can go after companies. They levy hundreds of millions of dollars of fines, and they're looking after the consumer's best interest, in their opinion. Trump didn't like them before. We'll see if they've had kind of a shell around them that no sitting president can seem to penetrate. So we'll have to watch them and see if Trump, because I know, again, he did not like them before. I doubt if he likes them again, but they have a lot of power. They've, implemented a lot of things as far as the credit card companies and the banking, as far as, how much banks can charge on return checks, credit card fees, so on and so forth. If he dismantles them or we put some constraints on them, that actually for these companies could be a very good thing. Bad for us as a consumer, but good thing, for those areas. So watch that closely. This next area is a very touchy area. I hesitated.
Not sure how it lands in finance, but
what's that?
I said I don't know how we landed this one in finance, but we didn't have anywhere else to park it, so I figured finance was the best.
Yeah, exactly. So we covered this on the show the day, I think, of the election, when it looked like Trump was, starting to build some momentum. So the scenario going on here is there's a number of private prisons around the country. The theory on Wall Street is if Trump implements, as he has already stressed that he will, his immigration policy and mass roundups of illegal immigrants are created, they've got to go somewhere at least temporarily. And the anticipation on Wall Street is they will go to the private prisons. So again, I haven't followed them since the election. I don't know how they're doing, since then, but this is an area that many are feeling could be very positive. There's actually quite a few of them in Florida. There's quite a few in California, so on and so forth. So we thought we'd throw that in there. And again, they'd be used as a detention center. So
yeah, and that's been an area for a while that, has been a hotbed or a lightning rod for the other side of the aisle too. So private prisons will be notable, and then also too, how will hotels, motels, things along those lines in terms of if folks need to be housed, could there be some pros and cons inside of that space as well, just given the need for place to house until folks are deported, if that is ultimately what ends up happening. So
absolutely. All right, trading commodities. Oh my goodness, this has been an on again, off again area. It always is, and I'm sure it will be during the Trump administration. Take it away.
Right. I mean, a lot of these are clearly tariffs is going to be notable for this space. Remember, currency is going to also be very important as far as dollar. How is it acting? Since the Trump election results, the dollar's been incredibly strong, right? Why? Because interest rates have gone up. Why? Because people are worried about spending, lower debt, or rather lower interest rates or lower taxes on consumers, thus not enough money coming in and more money going out. So the bond market, people often refer to the bond vigilantes. This is years and years and years ago, but really the bond market, which John's touched on a bunch of time, tends to be right. Where the stock market tends to be reactionary, the bond market oftentimes ends up being right. And you've seen interest rates move up quite a bit. And that's because, remember, the Fed controls the short end of the curve. The Fed is thought to be lowering interest rates, most likely again in December, but then who knows? We had a spirited conversation today on the show. But the thought is that the Fed could still lower interest rates by another 1 to 1.5% and still be sufficiently restrictive given where inflation is. Well, when people buy U.S. bonds, non-U.S. investors buy U.S. bonds, and we touched on this on our last webinar, they sell their currency, buy ours, and then buy our bonds. So they can collect that interest here, and they have dollar exposure. Well, a stronger dollar is something that benefits them from the currency standpoint, but it doesn't benefit them if they want to buy our goods and services because our things are really expensive. So commodities, oftentimes gold, silver, copper, those trade relative to dollars. If the dollar is strong, oftentimes things like gold and silver, which very recently running into the election, and we touched on this too, a lot of people on that side of the boat thinking buy gold, buy silver because of this reason, because of that reason, because of the dollar is going to go to zero. Well, the dollar hasn't gone to zero. In fact, it's gone straight up. And that's why gold was running and then it started to roll back over. And like I said, it could be a bit of a crowded trade. So keep a close eye on some of those things, your gold, your silvers, your more inflation-based commodities. On the flip side, if you have tariffs, Now there could be some different supply demand situations. Steel, we mentioned earlier, but other industrial commodities, some we have to import, some may cost a lot more. That could import inflation, certainly if we aren't the even first, second, or third largest producer of some of those things. So tariffs are going to play a massive role in what commodity prices do, and that's why inflation could get worse, because we don't know where that inflation bubble is going to pop up once we start messing with the supply-demand dynamics, certainly for commodities.
Right. Let's spend a little bit of time while we're on this slide talking about tariffs, because there's a lot of confusion. Are tariffs good? Are tariffs bad for the economy? It's a mixed opinion. First of all, you'll get some economists that say it has no impact whatsoever. You'll get another side of economists saying they're terrible. They're like another tax, right? So for those of you that don't really understand a tariff side of things, we have tariffs right now, right? And so look at it as, I'll just make it a really simple example. We'll take, I'll just going to pick on China, right? If China wants to input a widget and we have the capability of making that widget here in the U.S., the Trump administration says we want jobs here in the U.S. So therefore, China, if you want to input that widget that maybe is a $10 widget, guess what? We're going to add a, pick your number, 50, 100 cent tax, whatever the case is, 50 cent or $1 tax to it. That's the tariff tax. So therefore, if that widget comes here to the U.S., you and I as a consumer, if we want that China-based product, we've got to pay that higher price, the base price plus the tariff tax. The idea and the strategy is, all right, there's got to be a company here in the U.S. that wants to make that widget, and therefore there's not going to be that additional tariff tax, so they can make it cheaper. It creates jobs, builds factories, so on and so forth. The problem, as we've brought up many times, the problem we've ran into under the last time Trump was in office was, it started with the likely products and things that we felt like automobiles, et cetera, that, okay, we all agreed on that we'd rather have GM produce something than a foreign country do it. Where it got out of hand was all of a sudden he went after all the countries, right? Our allies. He went after the European Union. He went after Canada. He went after Mexico, companies that we have great trade relationships with. But all of a sudden we became the enemy, right? He started to implement tariffs against all of their products. I think that was the extreme, and I'm hoping, I said this before, I'm hoping he doesn't go to that extreme because, I don't know if many of you, I know Jason echoes my comment on this one. We felt like here in the U.S., or at least I felt like it was us against the world, right? Yep. Everybody was tariffing each other, and I mean things as simple as whiskey. I mean, really, come on, we're taxing or putting tariff tax on whiskey coming in from the European Union. The most ridiculous things. I remember, Jason, we sat up behind behind the camera on the radio show and read down a list of all the crazy things that had tariffs on there. Remember, it wasn't just your big things; it was razors, so on and so forth. So we got to watch this one very closely. But I love the point that you just made, Jason, that this can have a major impact on commodity prices. And I want to just go one step further. Let's use steel as an example. If tariffs, let's say they're pretty expensive tariffs, are put on China steel coming in, well, guess what? If we need that, and that's the other problem we run into, especially with this infrastructure spending, if the demand is stronger than what our U.S. producers can produce, we've got to go overseas to input steel in this example. So therefore, our costs go up. And, especially if you're talking these infrastructure projects, now you're talking municipalities, cities, counties, states paying a lot more than they originally would have without the tariffs. And then, of course, there goes the commodity prices going up. Here comes inflation. So it's a very serious subject, and one that probably, Jason and I probably have I'd say one of our top 5 worries of going into next year. It's how severe are the tariffs going to be? And like I said, the tentacles spread very deep in the economy as far as the impact that's going to happen.
And adding on a bit to that point is, if COVID taught us anything, U.S. companies are not immune from gouging customers too, right? So if you take China as an example, or Mexico, or whoever, and you put a tariff of 20 or 30% or whatever it is in order to make that U.S. good theoretically more competitive in a market, U.S. companies oftentimes are going to raise their prices too to be just under where the tariff price is. I would love to think that's not the case. You'd be naive to think that it's not the case. So that's why inflation, unfortunately, will pop its head up somewhere else versus where you think it's going to be. And so that's the part that we need to keep a close eye on. Hopefully it just becomes more art of the deal saber rattling and we're able to negotiate favorable terms with other countries, I'm hoping that that's what the inevitable outcome is. But the tariff thing is always something that's difficult. It tends to go more the other way, where it's us against you, against you, against you. And I don't think any of us want that.
No, not at all. So that wraps up this segment of the presentation in regards to the sectors. Again, the positives, the negatives that are there. Now let's start to drill down a little bit further into the potential impact on taxes. As we started this year off on the radio show and telling our clients, we've got something we're worried about in the future, and that is the sunsetting provision of the Trump tax initiatives that he had and put into place when he was in office. We were very concerned that if Democrats did get in, those income tax and various tax provisions were going to expire, called sunsetting, at the end of next year. And folks, they've been very significant. Now, you saw, of course, when Harris was campaigning, she's just like Biden. She was all for raising taxes. Trump is just the opposite. He wants to cut taxes. So what's on the table, and I use that term very seriously, on the table, because no one knows what's going to happen. You have to get congressional approval to make any tax changes. Now that we have the House and the Senate, maybe it's going to be a little bit easier, but there's still going to be some out there that are going to be, a little bit careful. But here's what's on the table. Corporate income tax going from the new kind of quasi-new rate that actually Trump put into place as part of his negotiation, from 28% down to 21%. Jason, why is that so? It doesn't sound like much, right? 7%. Why is that so important from a Wall Street perspective?
I mean, I think it just gives a sense of now you've got more assets, more income to spend to grow your company. And that's the plan that they're trying to focus on, is trying to come up with ways to grow the economy. I have a slide in front of me. I'm more than happy to share. It's on the U.S. Treasury website that really highlights income versus spending on the federal level. And if we're going to cut taxes like we're doing here, the hope is that we're going to grow the company or country enough that the revenue is still larger, though the aggregate impact is lower, or the individual impact is lower to both personal and corporate rates. But it's tough, right? You never know. Ultimately, we have new technologies that U.S. wants to be very much involved with. Clearly, they mentioned cryptocurrency and trying to keep those things here, but U.S. leadership in AI, the U.S. leadership in all this sort of big data structure with NVIDIA and names like that is hopefully something that we can continue to have, and then have more of a tax base to get some money from. But yeah, the lowering of corporate certainly should help, because you don't want to do the other side, sort of as the fear with Harris is, then you just choke off the victim. They can't make enough money to ever grow or succeed. And you're stuck back in the same spot, no income, because nobody's around to produce it.
Right, absolutely. As many of you are aware, just last week, the Treasury came out with the new tax rates for 2025. So you can find those at the irs.gov website, kind of get an idea. We also pay very close attention to capital gains rates. One thing that feared us the most of the Harris administration was they said it was you had to make $100 million more, but you were going to potentially be taxed on unrealized capital gains, which would have been the most ludicrous thing I could have ever thought of. But it was out there, and Lord knows it could have become popular. And then we all know it always starts with the wealthy, and then it works its way down to everybody else. We don't have to worry about that anymore. So we're very excited. I think Trump, one thing that Jason and I as business owners, by the way, everybody say congratulations to Jason. He's now officially a partner of SWM. Absolutely. But one thing that we really enjoyed as business owners under the tax initiative of Trump was the acceleration of depreciation, the expensing of items, so on and so forth. That was a massive stimulus for manufacturing companies, farmers, so on and so forth. I'm hoping that he's going to come back and refresh that a little bit. And so that's what we call Section 179 deductions, where you can expense an item north of $1 million in the year you buy it, instead of depreciating it out over a number of years. It sounds crazy, but it really helps businesses tremendously. So I'm very excited to see, A, who the next Treasury Secretary is going to be, and B, what the Trump administration can do. Because if we can get that refresh, if we can get personal income tax rates coming down a bit, we know that the corporate rate's going to come down. I'm confident that's going to happen. You're talking a massive stimulus boom to the economy. Now let's shift over to the next area, the interest rates. Again, Jason and I had a great discussion at the beginning of our show today talking about interest rates. And so we want to take a few moments because there's a lot of misconception of what's going on and why rates actually have gone up versus going down, right? So let's take it back to September 16th. The Fed announced, as anticipated, a 0.5% interest rate cut. Everyone's anticipation was, hey, my credit card interest rate is going to go down, my auto loan, and oh, by the way, I'm shopping for a mortgage. I know that's going to go down. And we cautioned everybody, that's not the way Wall Street works. So Jason, I want to take a moment and explain what really happens when the Fed announces an interest rate cut. Remember, when they announce a cut, that's called the Fed funds rate. The Fed funds rate is the rates banks charge one another to borrow money overnight. So if Jason's bank A, I'm bank B, I got a bunch of deposits coming in. Jason's like, man, I got a bunch of money I need to lend out. I don't need all these deposits. So I lend him that money for him to lend out and make money. And then he pays me back and I charge him an interest rate. That's the Fed funds rate. Now, what generally happens in the economy, of course, is mortgage companies, credit card companies, et cetera, they will look at what the Fed funds rate and adjust up or down based upon that. But we saw something very unusual. And this is why, Jason and I had this great discussion tonight or this afternoon on the show. And that is, it's not really worked, I think, the way everybody thought it was going to or want to work. And that is, if you look just at a 30-year mortgage, we're up almost 1%, almost 1% on the 30-year mortgage on a national rate, 0.80% to be exact, as of yesterday, since the Fed gave us a 0.25% cut. So we're anticipating a 0.25% cut at the December meeting. There's over an 80% probability of that happening as of today. But again, I use the analogy, it's like spitting in the wind. You're really not going to see it. More importantly, it's the bond market and what these bond traders are predicting as far as the future is concerned. That's where we're going to see interest rate movements either up or down. Take it away, Jason, as far as what goes through the mind of a bond trader and what he or she is looking at to determine, are they buying or selling, and then that relationship to interest rates.
Yeah, I mean, again, as you mentioned, the Fed controls the short end of the curve. They don't control 1 year.
What do you mean by that? It's like treasuries, 2 years, 3-year maturities.
Overnight, right? So you've got the whole gamut of duration. Short-term treasuries, say, out 1 year, and then you've got your intermediate term, 1 to 7 years, and then greater than 7 is more sort of long term. You've got 10 and 30 year and so on and so forth. They're really, really, really far out, very sensitive to interest rate stuff, right? So quick on bonds. If the Fed raises interest rates by 1%, right? Someone who owns a 1 year treasury, they're only exposed to that 1% difference for 1 year, right? Well, that would change the short end. Well, farther out, 3 years, 5 years, 10 years, not only do you have that 1%, theoretically, now you've got 10 years of 1% more that folks are thinking they could be earning. So with the fact that the curve has flattened and actually now reverted, the normal treasury curve is upward sloping, as in short-term rates are lower than long-term rates. That's how things normally are. We've been in an inverted environment for going on 2 years, as in short-term was higher than long-term rates because the Fed has been holding them up, right? Because they were trying to combat inflation. And now they are slowly letting the balloon down because they've brought inflation back more within the realm of where they want, right? Lots of people are like, prices aren't down. And John and I are saying, we agree, they're just going up less. And that doesn't feel good, especially when you're really high now. But the Fed is saying, look, we're in a more normal inflation environment. Our growth is getting closer to where we think it should be on an annual run rate. And they're bringing down those rates. But the long end of the curve is saying, I don't think you're going to get as low as you think you're going to get, Fed. We're staying higher for now. The market is telling you that we think you, Fed, need to pay us more than you think you should be able to borrow money from us for 2 or 3 or 5 or 10 years. So that is what is happening right now, is the market is more so saying, we think that inflation could be higher than you think. We don't think that we want to lend you money, because remember, when you're buying a bond, you're just lending someone money, and they owe you your money back at the end, and they owe you interest every year. So the market's just saying, no, I'm not going to go down to where you think you're going to take us. We want more for that risk. And I use that word on purpose. It's risk. That's all that interest rates are, is the market pricing in a probability of some kind that either A, you won't get your interest payments, or you won't get your money back at all. And as you buy treasuries or corporates or high yield bonds, that's why they cost more for the lender, or rather the borrower, because there's a probability that they default. So the market right now is sort of battling with who's going to be right. The Fed, who controls that short end lending market, or the economy and what is not a policy so far from Trump or even Harris to fix the spending side. So the market's just saying, I don't think the rates are going to go quite as low as you do. Hopefully that helps a little bit.
Yeah, great explanation. And so the bottom line, where do we think rates are going? Jason and I actually differ on this, which is what makes our partnership so great. I think rates are going to go higher. I was very staunch on this topic last night or yesterday afternoon on the show with Corey and Dwight. I think mortgage rates are going higher. I think all the rates are going to go higher. And here's my rationale. Economy is going to be increasing under the Trump administration. I think inflation is also going to increase, and therefore it's going to be, the Fed may continue these little, like I said, spitting in the wind, 0.25% cuts. It means nothing. But the bond traders, they don't, those bonds Jason was just talking about, if you own a bond, your biggest enemy is inflation, right? If you're earning 3% on your money, but inflation is at 2%, guess what? Your true return is only 1%. So if inflation goes up and so on and so forth, it doesn't make it worthwhile. That's a big benefit to the stock market. And that's why we're starting to see, these last few weeks, especially rates moving up because the stock market's been going up. And so we've got to be very careful. One of us are going to be right. I hope it's him, to be honest with you. But in my heart, I think that we're going to see a rise in yields, meaning higher mortgage rates, higher interest costs for us as a consumer and for corporate America, and inflation rising. So that's why we want to spend some time talking about commodities and things that are more inflationary positive in that environment.
Yeah, and interest rates at the 4 to 5% level are normal. Right?
They are. Good point.
Longer term, I agree. I think interest rates probably do go higher, but I think over the next, call it 6 to 12 months, that interest rates are lower than where they are now. That's right. And hopefully I'm wrong. But, again, the reason that rates would go lower is because the market is pricing in more Fed cuts because of potentially a stalling economy, right? Remember, interest rates going down could also go hand in hand with stock market going down, right? Because that's why the Fed would lower rates more than the market thinks it's going to. So sort of think of that part too.
Yeah. Yeah, both of us have an argument, and again, no one knows. Obviously, only time will tell. So we just want to kind of give you both sides of our analogy there. Well, that brings us to our second to the last bullet point, which is what should be your long-term and your short-term strategies at this particular time. Well, again, I use this analogy the day after the election, and that was it's a brand new ball game, right? It's the first quarter, to use a football analogy. It's the first quarter. We are now, as portfolio managers, beginning to maneuver and realign portfolios going forward for all of the areas that we were just talking about. We've got to think about taxes. We got a lot of things we got to be thinking about. So your long-term strategies, obviously, those of you that are our clients, first of all, we are grateful for you. Those of you that aren't, we hope that we earn your trust and you give us a chance to become your portfolio and your financial management company. But those of you that self-manage or have other advisors, this is the time you want to be thinking about this. How does my strategy need to change? Because I promise you one thing, 2025 is going to be different than 2024. There's going to be different areas of the market that are good, different areas that are bad. We've got a massive amount of changes coming up, and we've got to do our best to predict where those changes are going to be. And as old Wayne Gretzky said, we want to go where the puck is going, not where it's been. So long-term strategies, look at your personal goals, look at your risk tolerance, look at all the things that we have going on in the economy, and try to do your best to anticipate all these things that we mentioned tonight on the webinar. But this is what a good advisor is going to be doing for you, is not sitting going, hey, you know what? We had a kick butt 2024. Your portfolio was up 20%. that was yesterday, right? This year is going to be over before we know it. The slate's going to be clean. Now we got to get prepared for 2025. So it's the old basics, which is, risk tolerance and goals and so on and so forth. Don't get caught up in the market gyrations. What about short-term strategies, Jason?
Yeah, I would say, dovetailing into what you're saying exactly, is there's a lot going on right now. Again, crypto moves and AI moves and, energy moves and financial moves. And I would just recommend, please don't get too heavy into any one of these things, right? Gold bugs thinking that the end of days is coming and, crypto is going to go up 100x. Like, weigh your bets risk appropriate, right? I'm not saying try everything, right? Feel free. If that's your comfort and your risk tolerance, I don't think, a client's ever spoke to me and then I've said that's a stupid idea. I am a massive fan of diversification. John is too. Feel free to nibble on anything that you think could work, but don't get too heavy in anything, given all of the major cross currents. We haven't really heavily discussed the geopolitical tonight as well. I would argue in 2025, if I had to pick the thing that was going to cause the most volatility, it's going to be that. And that's really not interest rate. That's not really, specific to commodities or financials or anything. It's just instability of some kind that could come out of anywhere. It may be none of the players that we're focused on now, but I think going into 2025, still very optimistic. Demographics are there. The millennials are bigger than the baby boomers. The average age in the United States is 37 years old. We've got good jobs, good technology future for the country, and there's going to be a ton of opportunities, but at the same time, make sure your risk is appropriate given the gains that we've had this year. I joked on the show and said, everyone fancies themselves a stock picker right now. Those are typically the times when you get a comeuppance of some kind. In a sector. Doesn't mean the market's going to crash, but you could find yourself too exposed to something oftentimes if you lean a little heavier than you normally would. That would just be the biggest takeaway for now.
Yep, love it. Lastly, our actionable steps to protect and grow your portfolio in uncertain times. And again, uncertain times, we don't mean that as a negative, but they are uncertain times. We've got a brand new administration. I can't remember the last time that there's been a sweep where one party controlled all three, White House, Senate, and of course the House. So this is going to be a whole brand new territory. So we do have some uncertain times. The main thing that you need to do at this point is keep the emotions out of your investing decisions. This is going to be, at least this first year, a very emotional year. There's going to be a lot of optimism, a lot of nervousness. That's when Wall Street will suck you in and dump you very quickly, right? And that's why we were just emphasizing on the previous moment, it's about the diversification. It's about aligning your portfolio with your goals, right? If your goal is to save $1 million for retirement, don't let the day-to-day gyrations worry you. That's what you pay a financial advisor such as ourselves to do, right? We're the ones that get the gray hair so you can go live your life. But there's going to be things that you're going to have to do. You're going to have to, as we said earlier, monitor what the tax situation is, monitor what's going on a geopolitical basis, monitor interest rates, monitor inflation. There's a lot of different things, but every one of you are different. Not one of you that are on this webinar, not one of you are the same as the person, your neighbor that's listening tonight. Yeah. Every one of you are different. That's where we like to specialize in a customized plan for our clients, because you have different goals, you have different risk tolerances than somebody else. Also, the other actionable plan is make 2025 a year that you include your significant other, boyfriend, girlfriend, husband, wife, wife, it doesn't matter. Include them in the investment decisions as far as your actionable plan. Because if both of you are not on the same page, and we see this a lot with our clients, one will want to be this way as far as aggressiveness, and one will want to be this way. And it makes it very difficult for us as the advisor to kind of come into the middle. If you can come into your meeting or your account review or your new meeting with your advisor, that's where you want to sit down and go, look at, as a team, yeah, I'm aggressive, but my wife is very conservative. Great, let's go moderately aggressive or moderately conservative. Let's reach in the middle, almost like the politicians are supposed to do. But
Or
Those
or we build custom portfolios for each of you, and then you guys get to find it out.
There you go. That's the way to do it. That's the way to do it. But most importantly, again, your biggest action you can do is realize that emotions are going to be running very high, again, at least in 2025. Don't get emotionally involved in the day-to-day, minute-by-minute gyrations. Again, that's what we get paid to do. And be optimistic, right? This is a great chance. We've got an incredible opportunity for this country to grow, the economy to grow. Interest rates are very, very formidable. Hopefully they don't climb too crazy. We hope inflation, obviously remains at bay. We hope the real estate market remains strong and gets even better with mortgage rates, hopefully at some point coming down. I think, and Jason and Corey and Dwight both feel that the Trump administration is going to do something to incite the real estate industry because we can't just rely upon mortgage rates. There's got to be something else that they can do. And there's a number of ideas on the table. So the bottom line is take action. Be in tune, listen to the show each and every day. We try to bring you information and keep you abreast of what's going on in the markets and the economy. And most importantly, as we wrapped up our last webinar, and we'll do it again tonight, we're here for you, right? Jason and I, we're here for you, whether you're a client or not. If you've got a question, call us, email us, stop in and have a meeting with us. We'll be more than happy to talk to you about our philosophies, what we think about things, how we handle situations in the markets and the economy, and just embrace it. Last point I'm going to mention, I'm going to go on my soapbox on this one. This is a great time, folks, to get your children, your grandchildren involved in investing. I've had a lot of discussions, I don't know about you, Jason, with our clients lately. People wanting to start the 529 college savings plans and different things. You know what, folks? One of the great things that's happened in this industry, it's not good for us, but great for you. You no longer pay a commission when you buy or sell a stock. Almost every brokerage firm has gone away with commissions. You can go buy your child or your grandchild one share of your favorite company, Microsoft, Meta, whatever the company is, and you don't pay any commissions on there. There's no excuse not to take money and get a portfolio started for these kids because go to calculator.net. It's a great website and click on the investment calculator. I was doing this with a young kid the other day. He's 25 years old. And I said, look, if you just start saving a couple $100 out of every paycheck, he's got 45, 50 years to retirement. He was going to have over $1 million. That realistically can happen. Jason and I witness it every day. So get your kids, your grandkids involved in the markets and in the economy. And again, pick up a few stocks here, a few stocks there, build a portfolio. It's a lot of fun for them, much better than your cash just sitting in the bank at 1 or 2%. And like I said, I think it's going to be a great time to do that. Your final comments?
No, I just think that you said everything spot on. It's there's going to be a lot of volatility, which is a good thing. You can pick out your favorite stocks, and you've always talked about dollar cost averaging for folks who are looking at something that they want to add to. You can spread your purchases over multiple days or months or years, right? You don't have to go pot limit right out of the gate to buy your favorite investment. So just always do your research and spend a little time. It's an enjoyable feeling to find a name and buy it and win to it. I think that's been a positive this year. Talking to lots of clients who want to pick a name and own it and see it do as well as it has. It makes me smile for sure.
Right. It absolutely does. All right. 7:27. We went a little bit long, but we will stay here as long as necessary for any of you that want to start throwing some questions our way. No question's a dumb question by any means. Jason, you want to open up the area?
Yeah, we are good to go. And then too, one of our wonderful clients sent an email, just notable that he knows the gun space pretty darn well. He said that 30 to 40% of U.S. firearm manufacturers build their stocks and barrel in Mexico. So if there's a tariff there, watch some of those companies could be in a tough spot given rising costs. So right. I thought that was pretty good color for folks.
Absolutely. So folks, all you need to do is just type your comment into the bottom of your screen there and pose your question to Jason and I, and we'll give you a couple of minutes to do that. I know sometimes you guys want to, other times you're like, I'm tired, I just want to go have some dinner or whatever the case may be. But we'll stay.
And we get a lot of emails, from folks after the
fact. Yeah, absolutely.
Feel free to give us an email if you don't want to throw anything in the chat or anything. It's perfectly fine.
Absolutely. Yeah, best email, you can just send an email to info@sanchezwealthmanagement.com and we'll get it and definitely respond to you on that. Also, we're we're going to try to squeeze in one more webinar, of course, in the month of December. We've been pretty good. We've been having one every month for last few months, and we've really enjoyed it. We feel it's a very effective way to enhance the communication. Just again, be able to take it a step further versus what we're able to do on the show each and every night. And really, we thoroughly enjoy these opportunities to be with everybody and understand and kind of get an idea of what's going on with all of you. So also the other thing I mentioned briefly, but we want to mention it again, we want to thank all of you that are our clients. We sincerely appreciate the trust, and we take managing your money, your retirement savings, etc., very, very seriously. It's a massive responsibility that we welcome. And again, we're very, very grateful for. Our firm has had an incredible year today, thanks to all of you as far as asset growth, etc. And we want to continue to grow. And we got some incredible things coming down the pike for 2025 that can't say anything at this point, but we will make some announcements, and just really looking forward to 2025 and moving forward with my new partner.
Amen. Yeah.
Amen. All right. Well, it looks like all of you are going to be a little bit shy tonight, so that's okay. Again, you can reach out to us at info@Sanchez Wealth Management, or give us a call at 775-800-1801. And we'd love to chat with you, have a meeting with you, go over your portfolios, whatever the case may be. We're here for you. That's the bottom line. Obviously, we won't speak with you before Thanksgiving, so it's going to be here in just a few days. My goodness. So we wish each and every one of you a wonderful holiday season with your family. Hopefully you get a chance to relax a little bit and have a very good time. Looks like we got one question here with Mr. Quigley, but I'm not seeing the question pop up. All right, Mike, if you want to
read it.
What's that?
Essentially, concern about policies in general, given is Wall Street going to push back potentially on the changes that could be coming from the new administration? Obviously, Wall Street historically tends to fight. You've seen Elon Musk. You've seen folks like that latch on. Will there be some folks who push away? Are there anyone you can think of, or any areas that you think may fight back against Trump if he makes changes to either markets or more specifically institutions?
I can't really honestly think of any. I think let's just go back to the sectors, look at the leaderships in those sectors that we discussed. I think every one of them can benefit, again, unless something, probably the only one that I'm a little concerned would be with the healthcare, the biotech, or the pharmaceuticals. If he goes after the ACA and tries to dismantle that always, we've seen that game a number of times, and you can see a negative impact there. But man, everybody else, I mean, I know there's a lot of CEOs that didn't want to say they voted for Trump, or maybe they didn't, but I think now they're very happy because they know their taxes are going to be lower and there's going to be a big economic boom, hopefully. And so no, I'm not concerned about anything. How about you?
No, I would agree. I think in general the favorable background from change in terms of, you mentioned taxes, and also that there isn't a change coming near term to tax rates, I think is going to benefit